a run rate of about $1 billion, which is staggering growth for a company that's only recently commercialized. The cost of building that and commercializing technology leaves them with, I'm pretty sure, negative margin. So the company that can solve out how to actually make money from selling software, AI is just software, that's kind of where the battleground is right now and the point of differentiation.
Yeah, that's a really good point. I'm just would like to say for the record, Ed, you are not broken. You're like Arnold Schwarzenegger or something. You have had a killer week, and I know you've not slept at all. But Alex, to come back to you on this idea of OpenAI not being just about Sam Altman, but really the concentration of power of a few individuals to be able to oust him, to exercise so much control over this technology. There's going to be new people coming in now, and I just wonder how how you view that potential board composition, the reworking of it that we could see.
Yeah, I mean, look, it's all ultimately going to benefit Microsoft to a greater degree than it did previously. It's been reported, not least by us, that there'll be potentially 2 Microsoft members on this expanded board. It's going to be, as many as 9 additional directors. That also has the effect of diluting the ability of a very small group, and that is fundamentally what the existing or the pre-existing board was, dilutes their ability to take these sort of very quick actions without consulting a lot of different stakeholders. Microsoft didn't really know that Sam Altman was on the way out until minutes before the rest of the world did. So this will make that a far less likely proposition.
Are we understanding that this is not a very grown-up industry? It is embryonic. It's moving very quickly. It's consuming huge amounts of resources and money, but it's still very embryonic. And that's the kind of the other takeaway from all of this as well, is that we need to see this industry growing up, that we need to see checks and balances put around it, we need to see corporate governance put around it, we need to see some grown-ups in charge. Is that where we've now got to by the end, kind of midway through this week?
Well, that's certainly what's happening with OpenAI, right?
Is it true elsewhere, though?
The thing is, the big AI research labs that we see, which is basically that are largely attached to big private companies. We're thinking about Meta AI Research, Google DeepMind, now with OpenAI, with a very close line to Microsoft, and Anthropic, which is probably the most independent of them all, but does now have a relationship with Amazon. But those 3 that are at big companies, they have a lot of sort of, in inverted commas, adult oversight. I think the way to think about this is we're kind of from an industry evolution stage where social media was perhaps 15 years ago, right? And it's taken 20 years for us even to have a thought about how you regulate social media. That is happening now. Is 2004 that Facebook was launched. That is slightly concerning with OpenAI, given the possible implications it can have.
One point of difference that I'd make is that we did learn that AI is expensive, but what we learned, particularly in OpenAI's case, is that the entirety of its value is the intellectual capital of its people. That we realize if they all jumped, there is no OpenAI. One thing I would say is that we still don't know why he was fired, and if it really is this philosophical difference between Sam Altman, who wants to commercialize, and a board that was largely made up of academics, remember one thing: we're not talking about the AI that's already out there, the current version of ChatGPT. What we're talking about is GPT-5, the thing that isn't out yet, that comes next. That's what people are scared of, but it isn't business people working on that. It's data scientists and researchers who have a different motivation, potentially, than the investors who want to make a return in the long term.
All right, very good point. Bloomberg's Ed Ludlow and Alex Webb, thank you so much for joining us. We appreciate it. And of course, we also should note that one of those new board members of OpenAI is Larry Summers, who's a university professor at Harvard and is a paid contributor to Bloomberg TV. We also need to note some breaking news that crossed at the top of the hour. We got the final read on UMich sentiment for November, and what's moving the market is the tick upward we saw in inflation expectations. The one-year inflation expectation moving up to 4.5 from 4.4 in the prelim read, and the 5 to 10-year outlook at 3.2%. As a result, you're seeing at the dollar at the highs of the session, the Bloomberg Dollar Index stronger now by about 0.5%, and the 2-year yield at the highs of the day up by 4 to 5 basis points. We're looking at 4.92 or so on the 2-year Treasury at the moment. Coming up, though, we'll get back to our question of the day. Carol Schleif, CIO at BMO Family Office, will weigh in on what she thinks the humans have learned from the robots this week. This is Bloomberg.
NVIDIA's come a long way.
These are really good numbers.
Blowout earnings revenue.
Not much surprise.
Overall, I think the tape was what most people expected.
Everybody was expecting already a strong guidance and strong numbers.
Not a lot of excitement in the stock price.
The selling that came after is a byproduct of the fact that everyone expected this really significant beat.
Investors have just become accustomed to such blowout numbers by NVIDIA.
There's significant demand coming for NVIDIA's GPUs even outside of China.
The stock did very well past month.
Just because of the space they're in their participation in the AI boom.
It looks like it is set to do well.
There's room for them to run up.
NVIDIA has more runway ahead.
Those are some of our guests on Bloomberg TV reacting to NVIDIA's results. You got the beat, you got the raise, you do not get the reward. The stock right now down by nearly 4% in the first 45 minutes or so of trading today. So that brings us back to our question of the day. What did humans learn about AI this week? Joining us now is Carol Schleif. She is CIO at BMO Family Office. Carol, is what we learned that even though AI has this tremendous potential and companies like NVIDIA are capitalizing on it, they can only do so quickly?
I think that's a piece of it. It's important to remember this is a very nascent, well, it's not a nascent technology. It's been around for a long time. It's nascent in the public eye and in the investment eye. So it's much like trying to deal with a toddler where you've got a lot of exuberance, a lot of naivete, not necessarily much nuance, and trying to figure out how all of that plays near term and long term is important. And we've seen it time and time again. We saw it with biotechnology back in the mid to late 80s. We saw it with the internet in the 90s, where there's a lot of exuberance, a lot of Wild West free for all in the beginning. And then it settles into a more reasonable, as you start thinking through intermediate and longer term, what implications does this have for investors, for citizens, for everything else. But yeah, there was a lot we learned this week about governance and that fight between potential existential threat, which everyone's talking about Terminator, but I bring to mind more the Matrix movies and that potential existential threat, I think, is what people are worried about.
I'm not sure which one is scarier. Carol, let's talk a little bit about, therefore, as investors, what you do with that. NVIDIA at the moment has got the pitch to itself, but it's not going to have the pitch to itself for very long in the big scheme of things. You talk about the fact that a lot of these AI companies are like toddlers, and you bring up what happened with the biotech industry. The toddlers are kind of bouncing into things. Some of them are going to fall over at one point. Some of them are going to stand up. It's like herding cats. But the lesson for investors from the biotech story was invest in a basket. Don't invest in single names. Is that the way you, as an investor, should think about this process?
That is definitely the way we're thinking about it. And it's also important to remember, too, it's not the industry itself. It wasn't just biotechnology. It was also broadening out into its impact on medical services and the delivery of medical services in general. And artificial intelligence is going to have that same impact when you start thinking about the impact on diagnostic imaging, the impact on specific medical care. If I'm diagnosed with some sort of disease, being able to map my genome and rapidly compare it using artificial intelligence to customize the sort of medical treatment I'm going to get. There's industry after industry that artificial intelligence is already impacting and going to continue. So thinking through as an investor, who has the most pristine data sets that artificial intelligence is going to be trained on? Who has, as you mentioned in your earlier segment, who has the financing to support the buying the chips, buying the time in the data centers and doing all of that research and training. So there's lots of different ways of thinking it and having a diversified approach as opposed to picking a single stock or a single provider on some step of the chain, thinking through the build out of it and where people have that expertise is really important for building a diversified portfolio.
Well, while you are looking at building out that diversified portfolio, Carol, the fact remains that there are a lot of individuals plowing into very few names. We talk about the Magnificent Seven, the leadership NVIDIA as a single name has provided to the market thus far. I just wonder if you think that kind of concentration ultimately is sustainable. And if it isn't, if this isn't going to continue to be a big tech-powered market, what takes that leadership role, if anything?
Well, it's a great point because especially through the first 5-ish months of the year, we saw that Magnificent Seven carrying the indexes because on paper it looked like the S&P, the Dow, and the Nasdaq were doing exceedingly well. But when you took out those big seven and looked at the average stock, they were flat to down, and we've had that scenario playing out again this fall. And so it is really important to look at where the broadening can happen. We're hopeful that it happens in a number of different industries. Healthcare has been lagged a bit behind. Consumer names have been so-so all year, as we know, going into this important shopping season that we have commencing tomorrow, actually, for early Black Friday offers on through the weekend. But I think, too, for us, the industrial theme in terms of rebuilding our infrastructure, greening of the grid, improving of the existing infrastructure, which really hasn't been touched in many large cities, for example, for over 100 years. So there's, and it's very underrepresented in the S&P in terms of industrials, manufacturing, that sort of thing, and bringing, reshoring tons of energy there.
Carol, just a final quick question. The US 2-year yield spiking higher right now on the back of the University of Michigan final read, which shows investors are anticipating stickier inflation over the longer duration. Do you think the market has mispriced the cuts that we are anticipating from the Fed? Do you think those are going to be delivered? Do you think inflation is going to be vanquished next year? Because a lot of the recent rally appears to have been based on this idea that yields are tracking lower. What do you think?
Yeah, I think we have been sort of scratching our heads for the last year and a half at the resistance that fixed income traders in particular had to listening to the Fed saying we're not pricing in or we're not expecting cuts. And you saw that earlier in the Fed minutes earlier this week that there is likely to institute another hike next year as a cut. So pricing in the cuts, particularly in the first part of the year, we think was a bit premature. And we do think some of what you're seeing, especially in the UMich surveys, is in investors and citizens coming around to this realization that neutral rate isn't going to be zero anymore. It's going to be a couple of percent. And so getting used to the fact that there's going to be some more inflation in the system, not necessarily high double digit or low double digit like we had in the 70s, but you're going to have some level of inflation much more like the 90s were.
Carol, how many turkeys are you cooking?
2.5. One breast, 2 turkeys.
Excellent. I'm sure it's going to be a fantastic day. Enjoy it. I know you've got a whole crowd coming around. I'm sure it's going to be a lot of work, but great fun. Have a great Thanksgiving.
Thank you so much.
CIO of BMO Family Office. Still ahead, talking of turkeys, talking of farming, a little bit of a slowdown hitting deer. Shares under pressure. This after the company gave a disappointing profit outlook. Crops are down. It's feeding through into the demand for tractors and everything else. Details next. This is Bloomberg.
shares of Deere are dropping down the better part now of 7%, heading for the worst day since May of last year after forecasting smaller than expected profits. The world's biggest tractor maker is seeing weaker demand from farmers. For more, we're joined by Chris Cellino of Bloomberg Intelligence. So Chris, is this one we just chalk up to the fact that crop prices are down?
That's part of the story. You know, we expected Deere to come out with fairly conservative 2024 guidance, just given the pullback we've seen in crop prices and softer farm fundamentals. And I think it was pretty well understood that the cycle was turning. But this outlook was meaningfully below what our expectations were. Deere's forecasting net income to drop to about $8 billion at the midpoint next year. So that implies, you know, earnings per share somewhere around $28.50 in 2024, which is, you know, more than 13% below the street. This sets a very low bar and really we think is overly pessimistic.
In terms of what's been bought thus far, farmers have been clearly out buying a lot of kit recently. And at some point, was there a point at which that was going to reach a limit anyway? And kind of what is the relation? How does Deere respond to this? Do they keep going as they are? Do they try and sort of focus on the higher value products? Do they reduce capacity? I'm just wondering what the kind of how Deere protects itself from this trend.
Yeah, it's a combination of all of the above. You know, like I said, we had early indications that the cycle was turning, and crop prices are the best indicator of that. But to Deere's credit, you know, they've made a ton of investments in precision technologies and precision farming, which has really driven up the price of a lot of the equipment. But it also does deliver productivity and cost savings to the farmer. So we think their business mix has structurally shifted higher, which should help kind of mitigate some of the downside risk here to margins as we move forward. They're targeting 10% of revenue to be on a recurring basis by 2030. So we continue to see catalysts here that will mitigate some of the downside to earnings.
Chris, we only have like 30 seconds left, but would it be prudent here for Deere to think about not producing as much?
Yes, and we really saw that in fiscal 4Q. They took some downtime at their Harvester Works factory. I suspect we'll see more of that as we move into 2024 with the goal of really producing in line with retail demand.
Chris Cellino of Bloomberg Intelligence, thank you very much indeed. It's always a great day when we get to talk about Deere. Even if it's dropping, you get cool tractors on air. Never a bad day. Coming up, oil extending declines. OPEC Plus delaying its meeting scheduled for the weekend. Manus Cranny not going to that meeting. He may be going next week. Rebecca Babin of CIBC Private Wealth Group joining us next for some analysis. This is Bloomberg.